Good afternoon. Today we're talking about the balance sheet. The balance sheet for a business has to do with recording the things that the business owns and the things that the business owes. So when you look at a balance sheet in the classic sense, what you'll see three basic categories of accounts. And we'll go through them in this session in very brief detail so you can understand the structure and how it all fits together. In a further session, we'll go through them in more detail to expand on your understanding of how it all does record exactly what the business owns and owes. One thing we need to remember with a balance sheet is that a balance sheet only records the assets and liabilities of a business at a particular point in time. So when you look at a balance sheet in Australia, our tax year usually runs to the 30th of June. So you will find that the balance sheet records your assets, the things you own, and your liabilities, the things you owe, at that particular date. So whilst a profit and loss, as we've talked about, covers a period, usually 1 year, a balance sheet will cover a period of, cover 1 day, where your business sits at that particular day. So getting back to the actual format of the balance sheet, you'll notice there's three major accounts. The first one is what we call assets. Okay, these can be physical assets like cash at the bank, they can be cars, they can be product and machinery, they can be stock. They can also be what's called intangible assets, things you can't touch, things you can't feel. They can include goodwill, they can include intellectual property, they can include, in Australia, formation expenses, so the costs you've actually incurred to create the structure that you're operating in. So there's assets there that we record as at a particular date, and we record a value on them at that particular date. So that's the first part of the balance sheet. The second part of the balance sheet is the thing, as I've already said, called liabilities. Now, these liabilities are usually, could be a bank overdraft, it could be bank loans, it could be the people who supply you who you owe money. So what we commonly refer to as trade creditors. As I said, loans, and it can also include a thing called provisions. So where we provide for a future expense. That can be provision for long service leave, it can be provisions for redundancy if your business is looking at putting people off over the next couple of years. So there are a number of provisions in there. You'll also often see taxation accounts in there, provisions for tax, provisions for goods and services tax, etc., etc. The final section of the balance sheet is a thing that we call the equity section. Okay, so the equity section is what the actual owners of the business own. That's the net result. So once we take in all the assets, that's all the things that have got a positive value. So these are all positive. That's all good because we've got money in the bank, we've got stock, we've got assets, be they plant, be they buildings, be they land. And then we take off the liabilities, which are generally negative. So that can be money we owe to the bank, to our suppliers, to our staff, to the tax office. And then what happens is we end up with a result down here in the equity section. And that gives us the actual ownership of the business by the people who own the business, whether they be shareholders or if it's a sole trader, it could be the person who actually owns the business. So that's a very brief view of the balance sheet. As I said, we've got assets, which are the things we own, liabilities, which is the things we owe, and what's left is actually what we, as the owners of the business, actually do own. Hope that's been helpful. We'll expand on this in another session.